Now, I always do like to start, of course, the show with a summary of what I saw happening with the market this week. If you look really closely at this chart, it's just been going up and down here for a while,
Yeah.
right here at the end. I mean, this is a fair amount of time since really the beginning of April, kind of at the same spot.
Yeah.
You can keep going back. There's a little dotted line there. It goes all the way back to May of last year, a little over a year ago now, where we're at the same place also. Not a terrible thing to happen to the market. I know it's a little frustrating. We all like to see, more money being made and what have you. But a sideways consolidation motion has a advantage of kind of allowing companies' earnings to catch up to the price. Because honestly, if you pull back that chart and looked at a longer term, you'd see how much run up we had during the 2020 and 2021, pandemic period where there was so much money flooding out, interest rates were low. And so to raise rates as much as we have, really 5% for all intents and purposes, just in a year's period, a little bit more than a year, and have a sideways motion in that time frame, it's not an awful result. And it allows for kind of this consolidation of assets to happen. So, money managers and the big pensions and those types of things have low exposure to the stock market right now. So that's a power that can come in at some point in time. We've had 7% rates of return here on the S&P 500 for the last 2 quarters each, right? That's pretty decent. Now, we're still kind of in the same range from where we were back in August of last year versus, kind of that low point that we hit in October of last year. But not too bad altogether, really. But there's this tug of war that's going on right now with people that are afraid that inflation is going to spike and continue to hold up or be sticky. The Federal Reserve is going to have to raise rates too much and are going to cause a recession, right? And maybe they've already done it and they've already caused it. We just haven't seen it yet, that type of thing. On the other side, you have this group that says, hey, the prices are down, company earnings are still up. We've had some good rates of return here. Consumers are still buying and spending money as a whole, those types of things. And this market's going to take off, especially because so many people think it's going to do poorly.
Yep.
Right? If you look at the sentiment surveys, they're very negative. And when everybody gets on one side of the equation, they're already out. It leaves everybody else to kind of get back into the market as far as that goes. And so this week was, kind of, I'll call it inflation week, right? So we had some reports. So the CPI, here's the last 1 year of the CPI. That's a consumer price index. It's a basket of goods that is designed originally to show exactly, how much things have grown, in this case, over the same time last year, year over year. So April's numbers just came out, 4.9%. First time we've been below 5% for 2 years. This is the chart for CPI top line. That's everything. Inflation for the last year, pretty good trend. Yeah, I mean, it's definitely looking good. It's going the right direction. The Federal Reserve should be happy with that as a whole. Now, if we look at core inflation, all right, CPI, this is where we take out food and energy, which are considered quite volatile. They're also considered things that the Federal Reserve doesn't have so much control over. And so you see, first of all, it peaked in October and has come down quite drastically from October. However, if you look closely there, it is not much movement this year. It's quite flat. I would think if the Federal Reserve looked at that, they would think, okay, that's a little bit of a problem. It's a bit sticky, right? Something we have to deal with as far as that goes. And so we'll see what happens there. Right now, the market is betting 95% chance, no rate increase for the June meeting, right? A 50% chance that they'll actually be cutting rates in July.
Yeah, so they're thinking something's going to break before July.
Yeah, so that's kind of interesting because the stock market does well when rates are going down. That's no doubt about that whatsoever. However, if it's going down for some specific reason, sometimes the market will come down at least for a while during that period. So that's kind of the interesting thing. I would think that what the market is looking at is this banking issue that we're dealing with. That was one of the big things that came up this week was PacWest had reported earnings. The earnings were pretty good. Their outlook was decent. Stock was up. And then they reported that they were looking for the possibility of a sale. And that kind of got a firestorm of motion happening. And then they reported this week to the SEC that their deposits were down 9% for the week, right? So this is really fascinating. What's happening is big banks are under different regulations since 2008, much more stringent. They're more sound because of that. Regional banks have lighter restrictions on their money, and they're struggling because of that. But just a sort of even a rumor mill starts going. And because it's not the entire banking system, it's just these regional banks. If you're at PacWest, you say, well, I've got this money over here at Wells Fargo. I'm still under 250,000. I'm going to move that. Or if I'm over 250, maybe I'm going to move some to multiple different institutions. You know, maybe a lot more of the bigger banks, or by treasuries, or
yeah, with the bigger banks, I think people have gotten to the place where they think they're too big to fail in a sense. So the U.S. government's not going to allow Wells Fargo go under.
That's right.
And so, you know, there's some protection in that sense.
Yeah, and so they've been huge recipients of this. But that's the problem for the regional banks. It's why this isn't going to stop right away, right? Because now we're hearing about Western Alliance. And as soon as you start hearing about them, then somebody's already starting to move money from that bank.
Any kind of news is you start that fear, that cycle of fear.
Yeah, exactly. And you know, the banks work very simply in the sense that, you know, they take in $100 and then they push out $90, $92. You know, it depends on the bank. I don't know the exact regulations, but they don't have that money on hand. So when you have 9% of your deposits leaving, they probably struggle to come up with that money because it's out invested into mortgages and longer term bonds and things like that, that they really, you know, can't get back right away. And of course, the longer term bonds are worth less that they bought, you know, last year or what have you. So the federal government did set up an institution that allows these banks to go borrow against those bonds as if they were still worth what they call par value, which is what you'd get back if you held on to the bond. So, you know, I would assume a PacWest can go out to that institution and borrow and then, you know, make those withdrawals whole in terms of that money coming in as far as that goes. So very interesting what's happening there. I think that, you know, if you listen to Chairman Powell, he's not concerned about the banking situation.
Yeah.
However, the more problem we have in the regional banks, the more they're going to cut back on lending, right? I mean, First Republic just went out of business, and some founders, some massive shareholders just got wiped out, right? I mean, they might have had that stock forever. Their whole fortune's based on it. Sometimes they even borrow against that stock, you know, instead of selling it to avoid capital gains. Or if you're a founder, you don't want to show, hey, you know, I'm going to buy this $10 million mansion. I don't want to sell $10 million of stock. People might worry that I'm selling for some reason.
Yep.
And so I go borrow against my stock. Well, that stock just went to zero. So the other people that own these big shares in these other regional banks are going to be saying to themselves, hey, you know, let's make sure we have enough capital on hand so that we can handle this so we don't end up losing our mansions, right? Or what have you. And so what that does is that's sort of like a tightening on the economy. And commercial real estate is one of the big areas that regional banks lend to, right? And so you're going to see this situation where maybe commercial real estate starts to struggle even more than it is, because it's already struggling some because the pandemic, you know, and the hybrid scenarios that are happening, what have you. They're, you know, I don't know, in our building here, we've had open space for a long time. I've been in this building for almost 30 years. It's more open now than I remember it. And that's, you know, true in a lot of areas here. So we'll see how that plays out. We did get one other inflation report. And this is a producer price index. This is wholesale inflation. That's a pretty nice chart. And that's actually down to 2.3%.
Yeah, that's right in line with what the Fed's looking for.
It is. Unfortunately, wholesale inflation is generally speaking an inflation on goods. Yeah. And so goods have been kind of deflating already.
Yeah.
They were inflating during the 2020 pandemic because that's all we could do, and now they're deflating because we're spending money now on services on the other side. However, this is still a part of CPI. It will have some impact, and it is a precursor. You can see that it peaked out earlier than CPI did and came down, so it is still important as far as that goes. Unfortunately, this week all of this good news on inflation, in both of these cases, CPI and PPI both came in better than expected, was overshadowed by kind of the Pac West story and the debt ceiling.
Yeah.
So let's kind of finish up talking about the debt ceiling a little bit, kind of what's happening there. So they met on Tuesday, right? Apparently, not much happened. Not surprising, right?
Yeah.
The one thing that they agreed upon was that they didn't want a short-term solution, which is kind of unfortunate because a lot of the articles are talking about one of the best solutions is a short-term solution, which is where you have an extension to the end of September.
Yep.
And that is when our budget, runs out, and they have to renegotiate the budget. And that's essentially what the Republicans are trying to do right now is renegotiate the budget in order to let this debt ceiling increase. If you go to the 30th of September, you could do them both together.
Yeah, and it's pretty common for debt ceiling and the budget to be kind of on par together.
Yeah, and that would give some cover, I think, to the Democrats who don't want to, fold in this scenario where we're going to negotiate the budget anyway, so we can do that then. And so it's kind of interesting that was taken off the table. And then there was supposed to be a meeting, and I don't know that it actually is taken off the table. We'll see what happens here. But there is supposed to be a meeting that was happening today that got postponed. And so, there's good reasons that it could be postponed because things are happening behind the scenes that are good, and they want to, not get back together until they have some of those details worked out so they can do something more substantial when they do get back together. Or there's bad reasons where it just seemed useless after the first meeting. So we'll find out, over time kind of what happened there. But altogether, pretty interesting situation right now. The CBO, the Congressional Budget Office, just came out today and said that the government was going to be out of money in the first couple of weeks of June. So this basically collaborates what Janet Yellen was saying, that June 1st, was when we were going to be out of money. And there's obviously some wiggle room in there just because it's hard to tell what happens with the, incoming money. It's also fascinating to me that the quarterly payments are on June 15th. And so I think what's happening there too, the CBO is saying, hey, before those quarterly payments, we hit this low spot where we're going to have some trouble with the money. So you can have all this good news going on. You can have inflation falling. You can have the Federal Reserve stop raising rates. You can have all of these things that the market's been waiting for quite a while. You can have consumer sales doing well. Housing is still holding up. All these things for the most part are pretty positive. Even the stock market is still holding up.
Yeah.
However, you're not going to have the stock market running off here until this debt ceiling situation is resolved. And I think you'll probably continue to see some erosion in the stock market as far as that goes. Now, our signals are still the same, right? So we're at yellow on our fast signal for the stock and green on the slow signal for stock. And then the bond signal is still the same. We're at yellow and green on the bond signal also. So, we'll see how things play out. Could be a good time to be green because the market takes off because there's some resolution in the debt ceiling. I do think the market will move strongly if the debt ceiling is resolved because I think things have been good. I think they've been better than people expected. I think earnings have been better. On the other hand, if the arguments for the debt ceiling continue into a period where we are facing closer and closer to default, I think the market struggles even more. So yellow is not a bad spot to be right now. And we'll react one way or another. We'll go to green or go to red if we have to, and we'll deal with that as far as that goes. So anyway, that's what's happening so far. It's kind of a summary for this week. Another interesting week always is this. Since the pandemic started, it just kind of week after week has been lots of different things to learn from here as far as that goes. We still believe in staying very much diversified in the portfolio, especially in this environment. And we'll see what happens, next week. So look forward to seeing you. Won't be doing the summary next week, but we'll be able to because we'll be off on vacation next Friday. But nonetheless, look forward to seeing you the week after.